And for today's first session, we have Luke Pelger joining us. Luke is a partner experience manager with GreenPath Financial Wellness. GreenPath is a nonprofit organization with a mission to empower people to lead financially healthy lives. Since 2006, Luke has educated people on the topic of budgeting, credit reports, and managing debt. Welcome, Luke, and I'll go ahead and pass it over to you.
Thank you, Sarah, and good afternoon, everybody. Pleasure to be here. I wonder, are presenters allowed to be put in the drawing for the swag bag? Just a question. Sounds like something I'd want to be a part of. Pleasure to be with everyone and talking about this topic of credit. It's one of my favorite topics to talk about because it's so impactful in our lives as far as things that we're doing every day, things that we'll be doing in the future overall. So understanding how credit works, how's a credit score created, what we can do to maintain and improve a score. These are all skills and information we should learn. And fortunately, this information, once you know it, it's very simple to remember and do over time. The hard part of credit, just like budgeting and even a lot of other things that we do, it's not so much the building blocks or the information of it, it's the consistency of doing it over time. So credit, just like a lot of other things, once you know it and can start doing it, as long as you can do it consistently over time, you're usually in pretty good shape overall. So I'll talk to you today about credit building and managing your credit and what this will look like for you as you manage your situation, because we all may be coming to this with different credit profiles and different level of knowledge, in this particular topic. So I'm going to present this in a way that whether you're very experienced in understanding this topic or have a strong credit profile, or whether you're just establishing credit, either way, as I teach this, it should be pretty straightforward. And hopefully, if I do it well enough, there'll be a portion for you to actually tell us what we should know in some of this topic. So we'll get to that as we go. So let's jump into just very briefly, as Sarah mentioned, I'm with GreenPath Financial Wellness. GreenPath is a nonprofit organization. I'm going to mention just briefly what we do because you have the ability to actually contact GreenPath and go through a free and confidential financial assessment with us because of the credit union support of GreenPath. We can provide a lot of things to you through our financial counseling sessions that you may find valuable. So we provide what are called financial assessments. We can help you build your budget, talk about your goals, get an action plan for your situation. So regardless of where you stand with your financial situation or your financial process, call us. We'll give you the building blocks of a budget and an action plan for you. We can answer questions about housing, so rental questions and even pre-purchase housing questions. We provide that to you. We talk about credit as well, so we can actually access data from your TransUnion credit report and talk through some of that with you. So you can apply some of what we talk about today in your specific situation if you want to with us in a session. Then we also have conversations where we can talk about managing debt, credit cards, student loans, and other things. We'll talk about what are your options for handling debt. So I wanted to just preview that for you just briefly. I'll give GreenPath's contact information at the end. You can take advantage of GreenPath and call us for some of this information. So let's jump into why is credit important? Well, credit can impact your ability to rent or buy a home. It can impact your access to credit, opening a checking account, turning on utilities, getting certain jobs. In all of these scenarios, a credit check can be run for various reasons, right? Maybe it's a financing thing, or maybe, for example, with utilities, if you have a poor credit score, they may ask for a deposit to get those utilities turned on. Or certain types of jobs. If you have filed bankruptcy, for example, sometimes you can't get certain jobs. Certainly if it's in the financial industry, there may be limitations to certain jobs with something like a bankruptcy on your credit. So certain jobs, there are credit checks run, and you have to pass certain levels of things on your credit to be able to get that job. So credit can impact all these things. Notice how much of our life it touches: our housing, our access to credit, the opening of an account, utilities. These are day-to-day things that impact all of us. Credit can also impact how much you pay for things like insurance. Insurance companies can run credit checks, and that can impact the premiums that you pay. Certainly, loans and financing, your credit's going to impact the interest rate that you pay on those types of financing. Certainly with housing, again, whether a rental or buying situation, that can impact the cost, as well as utilities, like I mentioned, the deposit before. So from a financial perspective, right, dollars and cents are impacted here by credit potentially. So we want to be mindful of what those things are and what the cost can be to us. Let me give you an example of the financial impact credit can have from a, again, dollars and cents perspective. Let's take a 60-month auto loan for a new car. You're borrowing $20,000. This chart here actually comes from myfico.com. They have a calculator where you can plug in what you're trying to borrow and what it would look like based on different credit profiles. So here's a list of a bunch of different credit profiles. Let me just highlight out a couple things or a couple of the credit score ranges and what it could look like from a financial perspective. So let's say someone has a 620 credit score versus a 720 credit score. Well, with the 620 credit score, that person's paying a 10% interest rate. These are national averages, by the way. 10% interest rate on that car loan. The monthly payment is $426. Now compare that to someone with a 720 credit score. They're paying about 3% interest on that car loan. The monthly payment is $366. Only a difference of $60 per month. Doesn't seem like a whole lot of money. But when you look at the big picture, the total interest between what someone with a 720 credit score would pay and someone with a 620 credit score, the difference in total interest paid is over $3,600 on that particular loan repayment. So the better we can improve our credit, we can get better rates, we can save a lot of money over time as well. So credit really is important from, again, ability perspective to access certain things, but as well as the cost we're going to pay for certain things. So let's take a step back and understand, what is credit? Credit is an arrangement wherein someone receives goods or services now with the understanding that they're going to pay the lender later. And typically when you're paying later, you're also paying some interest in addition to the principal, in that financial transaction. So you're getting something now, you're paying for it later. When this occurs, right, regardless of the situation, whether it's a financial institution giving you a loan or a mortgage, or it's a friend of yours, right? You borrow money from a friend. What's the most important thing the lender wants to know? If I give you this money, if I give you this line of credit, are you going to pay me back? How are you going to do managing the repayment on that particular item? So credit is this situation where you're getting something now and paying for it later, but lenders want to know, if I'm going to give you this money, how will you pay me back over time? And so what's been developed over time, at least here in the United States, is a process to gather information about how people manage their credit and score how people are managing their credit, just to make it easier, more convenient to do some of the transactions that we do on a daily basis. So two things to understand: there's a difference between a credit report and a credit score. So first, what's a credit report? A credit report is just something that compiles information about how you've handled credit and debt accounts. So if you have a student loan, if you have credit cards, how are you handling those accounts? What does it mean by handle? Are you making the payments on time? Are you paying the amount that you owe? How long is it going to take you to pay that money back? This is all just kind of compiling the information so that people can look at that or understand that and say, okay, this person not just has a student loan, but they also have a car loan to manage. And so that's going to take away a certain amount of money from their budget. I have to be mindful of that and how much I lend them, because, well, they have the capacity to pay me back too, right? So the credit report just compiles information. The second piece of what you want to know about credit is there's a credit score. And so the credit score takes all the information from the credit report and it expresses all that information in a number. It's basically a number that evaluates the risk of what's shown on that particular credit report. So if you were to say, I want to improve my credit score, let's say your credit score is not where you want it to be. I want to improve my credit score. Well, the way to improve your score is to improve the information that's on your credit report. So we're going to talk today what's on your credit report so that you understand how that works. So as you improve that information on your report, it improves your score over time. One thing to keep in mind before we jump into the details is a credit score is not a financial health score, right? So when we talk about how someone is doing with their credit, a credit score is just an expression of the information on their expression of the information that's shown on their credit report. But just because they're managing credit a certain way doesn't mean they have good savings or a stable job or other assets that might be important for their overall financial picture. So it's important that we maximize our credit, get a good credit score, make sure we're managing that well. But it's not the end all be all to your overall financial health or financial wellness. So do keep that in mind. We want to be smart and balance all of those things together. But we'll focus today on how to do the best with your credit score. And the other topics that are being covered in the winter sessions, learn those things because those things will help you with your financial health as well. So take advantage of those other opportunities to learn. Here in the US, there are three major credit bureaus: Experian, Equifax, and TransUnion. These are the companies that are compiling the credit report. So when you have a loan, a student loan, a credit card, typically those creditors are sending information to Experian, Equifax, or TransUnion, or even all three, to help those companies compile your credit report. So it is important. We'll talk in a little bit about how to view your particular credit report if you have a credit report. You want to make sure over time that you do review all three of your credit reports to get a complete picture of what accounts are reporting on all three of those credit reports. So again, a credit report is just when you take out a loan, when you have a credit card, when you have a student loan, and you're making payments on those particular things. These credit bureaus, these companies, are creating credit reports for all the people that they have information on. So it's all just being compiled in one place so that when you apply for something else in the future and there's a need for a credit score, they can access all that data from the credit report that's there. So what information is on a credit report? And I'll give you a preview of what these can look like in just a moment. The information on a credit report is first identifying information. So this is just to identify you as an individual: name, date of birth, social security number, tax ID number, address. So when you apply for a loan, every time you apply for a loan or a credit card, you're putting that contact information in. That's what they're matching at the credit bureaus to create your credit profile. So your identifying information does not impact your score, but it's important that you check that information, because if on your credit report, when you view it, if there's a street address you don't recognize, or some piece of information is off, your name is misspelled potentially, that could be an indication of identity theft, where someone's trying to apply for things with your name or social security number and sending the information to a different address. So you do want to look at that and review that closely to make sure it's all accurate. Second piece of information on the report are your credit accounts, or the account information itself for your different items. So for the credit card, for the student loan, for the car loan, um, what are the details of that particular account? How much do you owe? What's your payment history? That is calculated into your credit score. So you want to make sure that that's accurate from a um, um, information perspective as far as how you're making payments on those particular accounts. It's also important too, again, if you see an account or a trade line that's not familiar to you, again, it could be an indication that someone's opened up something in your name. There could be identity theft going on or fraud going on. You do want to work on disputing that or investigating that with the creditors appropriately. Third piece of information are bankruptcies and collection accounts. So negative information, negative accounts that might be showing up. So if you had an old bill that went to a collection agency or was charged off, for example, that's going to show up on the report. If you did file bankruptcy, that's something to keep an eye on, or that's something that will show up on the credit report as well. And then last is inquiries. And this is when your credit report, listing when your credit report has been accessed for review. And there are two types of inquiries. One is what's called a hard pull. A hard pull is when you're applying for something, right? You're applying for the credit card, you're applying for the car loan, and the creditor is pulling your credit report to view that report for the purpose of making a decision. Yes, I will lend to Luke, or no, I will not lend to Luke. That's a hard pull. Hard pulls can have an impact on your score. It's not a lot. We'll talk about that later. It can have an impact though, because if you are granted that line of credit, it becomes an obligation you now need to take care of, right? So the more often you apply for things, that if you do it too much, too often, that can have an impact, quite an impact on your score. But those are hard pulls when it's being reviewed for the purpose of making a decision versus a soft pull. A soft pull is when you review it for your own purposes, right? For you as an individual, you have a right to review your credit report. So there's no harm in you reviewing your own credit report. Or let's say you have an existing creditor that wants to pull it to see if they want to offer you more credit or increase your credit line. They can pull it just for the purpose of they're doing it because they want to do something, business-wise with you. You didn't initiate that, so it doesn't hurt your score in those soft pull scenarios. So a soft pull does not hurt your score, but they're listed on your credit report, so you can be mindful of who's viewing that information. You do want to be mindful of the hard pulls, though. Who's applying? If someone's applying, who's viewing that information? So again, like other things, if you see a hard pull that you did not initiate, that again could be someone applying for something with your name or social security number or tax ID number, trying to get an account. So this is the information on your credit report. Notice it's mostly centered around these particular accounts, right? The credit and account information, any negative accounts, how often are you having your credit pulled for the purpose of a credit decision. Notice what's not on a credit report. Your income's not listed on your credit report. Other assets, so whether it's retirement accounts or investment accounts, other, even physical assets you might have. Savings is not listed on your credit report. So again, your credit report is not a full picture of your financial situation. Typically, when you apply for a car loan, a mortgage, they may be asking, hey, what's your income? What assets do you have? What savings do you have? Because they want to see if you're not able to make the payment on that item, do you have savings to back you up, right? Or how stable is your income at your particular job? So there are these things not listed on a credit report. So I want you to know that they're not there. And again, it reinforces the idea that credit's just one part of your overall financial health that you want to be mindful of. Now, if you've never seen a credit report before, I'm going to give you a very generic picture of what it looks like. When you go to the actual credit bureaus and pull this up, each of those can look a little bit different. But in general, the information there is the same, right? So I'm just going to give you a very simple snapshot of what it looks like. So first section, personal information, name, social security number or tax ID number, date of birth, addresses, right? Again, view this information for accuracy. This just identifies who you are. So that allows them to put the trade line or the information they need under the appropriate credit profile at those credit bureaus. And then there's the detail of the credit accounts themselves. So it lists who the creditor is, the mortgage company, the auto lender, whoever it might be. It gives the address of that creditor, gives the account number or a portion of the account number so you can identify which account it is. It also gives the account history and payment history. So are you paying on time? Are you paying 30 days late? Are you paying 90 days late? That's going to be part of the detail of the account. Also, what type of account is it? Is it an installment account? An installment account is something like a car loan or a student loan. The money is borrowed once, you make installment payments until that's paid back, and then the loan goes away, right? Versus a revolving account. A revolving account is something like a credit card. You have a $5,000 credit limit. You can charge up, you can pay it down. You can charge up, you can pay it down. So it just keeps revolving, right? It's there as a kind of a credit line as opposed to an installment account, which is eventually paid off. It gives the terms, right? So if you have an installment loan like a car loan or a student loan, how many months are you going to be paying on that account? What is the monthly payment? Also, this looks at the responsibility. Is it an individual account, meaning you are the only person that signed that contract or that loan document? So you're the only one responsible for it, meaning it's only showing up on your credit report. Or is it a joint account? A joint would mean two people or more signed for that item, for that loan, and it's showing up on each person's credit report. So if you have a joint car loan with a spouse or somebody, or there's a co-signer on a loan with you, it shows up on both people's credit reports. So both are equally responsible for that debt, and it's showing up on both credit reports. So this shows a lot of information about the account itself and how you're managing that account. So are you paying down the balance? Are you making the payments on time? Who's responsible for this debt? Again, these are all things that can be worked into a credit score as far as understanding what's the risk of you borrowing more money if you had to. Now, if you want to view your credit report for free, if you have a credit report, and you have a credit report typically, if you have debts or lines of credit that are open and active or have been used in the past. So if you have a student loan, as a federal student loan or a private student loan, you have a credit report, right? That's going to show these particular things that you owe money on. Why? Because those companies are reporting that information to the credit bureaus so they can create these credit reports for you. So if you have student loans, if you have um, um, a car loan, if you have credit cards, all these things are reporting. You should have a credit report that you can access. The way to get a free copy of your credit report here in the US, annualcreditreport.com. This is a website that you are allowed to, as a consumer, get free copies of your credit report. Typically, not during the COVID-19 pandemic, typically it was you could review your credit report from each of the 3 national credit bureaus every 12 months. With the pandemic, they actually allow you to do it every week. So you can go in every week if you wanted to view your credit report from each of the 3 national credit bureaus. And the reason for this, again, so you as a consumer can view the information, understand what are the trade lines I have, how's that information reporting, how's this impacting my score, right? As you understand how credit scoring works, when you see that information, you'll know how it impacts your particular credit score. So especially with the pandemic, the forbearance on payments or suspension of payments on federal student loans, it's not going to be impacting your score if you haven't paid for the last year because no payments have been required. But if you got a forbearance on a car loan or a mortgage or something like that, you want to make sure that that's appropriately documented on your credit report. Someone had the question in the Q&A, does viewing your credit report affect your score? No, if you as an individual are going to annualcreditreport.com and viewing the credit report as yourself, that does not hurt your score. So do this as much as you want to. At the very least, it's recommended check your credit reports, all 3 of your credit reports, at least once a year to, again, view the accuracy of it, understand what's there. So you as an individual viewing your own credit report does not hurt your score. So do that as much as you'd like with the parameters that you have through annualcreditreport.com. The If you go there, if you've never done this before, it's a pretty straightforward process. You go to annual credit report, you fill out a form with basic contact information. You choose which credit report you want, whether it's one or all 3. There might be a few security questions in there to verify your identity. And then you request to review the reports online. And the reports are typically allowed, or not allowed, but they're typically available, I should say, for up to 60 days after you initially pull the report. So you can go back and view the report again, or even download it and save it if you want to keep taking a look at it. Very straightforward process. Excuse me. You do not have to pay for your reports. This is important. You don't have to pay to get these reports. You get the reports for free. But do know in the process, they will say, would you like to purchase a score? You typically have to purchase a score. You can if you want to, but you don't have to. So that's all optional if you want to actually purchase a score to see where your score is at. What I would say though, as you know how credit works, it's less important to know what your score is. It's more important to know what's on my report and how it's reporting. So once you know if you've got a good score, as long as you keep maintaining that, the information is reporting correctly, you're typically in good shape and don't have to check your score very often. A couple questions. How often are credit scores updated by the major credit bureaus? Typically, I can't speak for every creditor. The information on your credit report is updated when the creditor reports that new information. So let's say you have a car loan with a creditor. Every 30 days, typically, as you're making, every 30 days, they'll typically send a batch update to the credit bureaus that says, these are all the accounts and here's the new information for each of these trade lines. So most major creditors send information to the credit bureaus typically every 30 days. So that information should be updating every 30 days, on the credit reports. Some creditors may do it less frequently. It just depends, right? But I would say every 30 to 60 days, new information is getting to the credit bureaus to reflect on your report. Another person asks, and we'll focus on credit scores here in a little bit, but we can touch on it here. How accurate would you say credit scores are through our banks? I'm going to nuance that question a little bit because I'm not exactly sure where you want to go with that. So please ask more if you want more clarification. Credit scores are very accurate because all really a credit score is, it's an algorithm that, or I don't know if it's truly an algorithm, but it's a math, process where it just takes all the information in from that credit report. So let's say I go to, my credit union today. I want to get a car loan, fill out the documents with my information. They access a website or database where they can pull my credit report. All they're doing is that credit scoring model that they use for their lending practices. It just takes the information from my credit reports, runs it through that algorithm, and it spits out a number. And whatever's reflected on my credit report will impact what that number is. So if I have good payment history, it's going to show a good score. If I have a poor payment history, it's going to show a lower score, right? So it's very accurate in that regard. It's a question of, is the information being reported to your credit report very accurate? Typically it is, right? Sometimes we'll find errors, misspelled name. Again, personal information doesn't impact a score, but maybe there was someone, as they were typing in your information for your payment, they did something wrong so that when the information was reported to the credit reporting agency, maybe it showed you 30 days late inaccurately. You should be able to typically clean that up pretty easily through a dispute, which is why you as a consumer want to view this information pretty regularly. So if you see, hey, it says I was late, but I know I was on time, you can have that creditor update that information and get it corrected on your credit report. So the number or percentage of inaccuracies really varies by your source, but I'd say less than 10% have a major inaccuracy that would really impact a score. But there's a lot of small things you could find just from simple clerical errors that could occur through the process. Another question, if someone were to use your social security number to use credit under your name and hurt your credit, is there a way to fix it or is it permanently damaged? There is a way to dispute inaccurate information. So through annualcreditreport.com, there is a dispute process for simple clerical errors or inaccuracies. You can dispute those. You can also dispute things because you think there might be fraud going on, right? So you can put a fraud alert on your credit report. If you see something that doesn't belong to you, you can get a fraud alert put on your credit report so they can't access accounts for a period of time if they were to try to do that. And then through the investigation process, things can get corrected and updated and cleaned up. So it is possible to fix things that have occurred. It just takes a lot of work sometimes. Sometimes it's simple, sometimes it's a lot of work. It really just depends the type of fraud or theft that was occurring as to the complexity of what might be involved as far as resolving that. So there is definitely a way to dispute those things, get them investigated, get them corrected. Again, just the complexity of what occurred there will dictate the next steps. So let's transition to what are credit scores. We've touched upon this a little bit, but let's dive a little bit deeper. So what is a credit score? In short, it's a 3-digit number that just tells you the likelihood of repayment. So again, all that information from the credit report gets run through an algorithm. Boom, here's your credit score. The most common type of credit score is a Fico score. So we're going to focus on that with our time today. It's a score that ranges from a low of 300 to a high of 850. The higher the score, the better. Let's talk about how this Fico score is calculated. There are 5 factors in a Fico score. Let's look at each one of these individually. First is payment history. This is 35% of a Fico credit score. Why is it 35%? Why is it the biggest percentage? Well, it tells a lender the most important thing. What does a lender want to know again? If I give you this money, will you pay me back, right? So payment history tells us, how have you paid back the accounts that you already have, your student loan, your car loan, your credit card, those other accounts that are reporting on your credit report. How are you doing paying the amount that you're supposed to each month with your minimum payment? And are you paying that on time each month? So this is 35% of the score. So what's the most important thing you can do? Pay your bills on time, right? So if you do have student loans that are requiring payments, again, if you have federal loans, that may not be the case right now, but when there are payments that are required, are you paying on time for those particular accounts and paying the amount that you owe? Second biggest is the amounts owed, which is the debt to credit ratio, or the amount that is owed on something like a car loan or a student loan. So let me parse this out in two ways. The amounts owed looks at, on say something like a credit card, what's your available credit and what's your balance on that particular account. Let's say you have a credit card with $1,000 limit and you owe $900 on that credit card. Well, what's your debt to credit ratio? 90%, right? $900 owed on a $1,000 credit card. So 90% debt to credit ratio, is that a good thing? Probably not. A lender is going to say, why do you have to borrow 90% of what you have available? Can't you pay that down? Can't you pay for the things you pay for, without using a credit card? So you want to have a lower debt to credit ratio on those trade lines. Most people say, good benchmark, less than 50% of what's available on that trade line. But even better, 30% or low. Or lower. So $1,000 credit card, do you owe $300 or less on that particular trade line? There's no hard and fast rule there. Just in general, keep paying those balances down. Try to keep those ratios low, right? Try and pay for what you need with cash, or use a debit card, or use the credit card, but pay it off in full, right? If you're carrying balances, that's an indication of if you're carrying a balance and it's risk, right? It's an obligation you have to repay. So that's all factored into the risk assessment there. So it looks at the debt to credit ratio of accounts, and then it looks at amounts owed on installment accounts. Let's say you have a car loan. The original balance was $20,000. After the first year, you've paid it down to $19,000, right? So that's good. You're paying the balance down. Every year, every month as you make payments, that number gets lower and lower. So what's the spread between the original balance you owed on that car and what's the current balance now? The wider that spread gets, the better it looks, because you owe less. Each time you make a payment, you owe less. So that's less risk for you to manage over time. So keep paying down the balances on those installment accounts. So that's 30% of your score. Why is it 30%? Why is it such a large percentage? Because again, it's an indication of risk. If you have a lot of risk out there, a lot of accounts that you owe money on, are you more or less likely to be able to pay that back? Well, according to credit scoring models, people with a lot of stuff that they have to manage and pay back are probably less likely than someone that's doing well with a smaller number of accounts or a smaller amount of debt, right? So it's not hard and fast rules there, but the general theme is less risk, less obligation is better in these particular scenarios. So keep paying down your balances and keep those those ratios low. Number 3 is length of credit history. There's nothing you can do here, but in the topic today of how do I build and maintain my credit, length of credit history is very important. So establish a line of credit. We'll talk about that briefly today. Establish the line of credit and just manage it well. And the more time that passes between when you open the account and when you check your score, the better, right? Because you have a longer history. So someone that's been managing credit for 10 years, right? And they're doing it well, typically has a better credit score than someone that's managed their accounts well, but they've only been doing it for 2 years, right? The length of credit history does tell a story in some cases. Fourth is new credit. So these are the hard pulls, the hard inquiries. So as you're applying for things, it's really only about 10% of your score. So if you open an account periodically, the store account at the local department store, right, get the 10% off, or open an account, a credit card with the credit union. If you're just doing it only as you need to, it's usually not a big deal. But if you start to get into financial trouble, as some people do, they start to apply for lines of credit or a bunch of credit cards, that's going to raise a red flag, right? Because the question is, why are you applying for so much credit? Why can't you afford to pay for these things with what you already have? So new credit, only apply for things as you need to, and you'll typically be fine. That won't hurt your score too much. And then the last factor is types of credit used. Now, this is just looking at what do you have, what's the risk level of that particular debt. So you don't have to, and typically people with a stronger credit profile, this can help their score. So if they have a loan, I'm sorry, a student loan, a car loan, and a credit card, it's typically better than someone with just a credit card. But you don't have to go out and get a car loan or get a mortgage just to try and improve this factor in your credit score. Just manage what you have well, and you'll do just fine with this factor in your score. This also looks at the risk of what's in that types of credit, right? Because if I asked you the question, or I told you, I have $200,000 in debt, would you know if that's a good thing or a bad thing? With just that information, the answer is no. But if I said I owe $200,000 in debt, it's a mortgage. Well, that looks different than if someone says I owe $200,000 in debt and it's all credit cards, right? Because credit cards are unsecured debt. To have that much out there based on who you are, that's obviously a high risk for someone to lend to, versus $200,000 on a mortgage is a secured debt, right? So there's an asset behind the money that's owed there. So that kind of looks at those types of credit use. What's the risk level of that, and what types of credit do you have overall? So those are the 5 factors in a FICO credit score. What I want to do next is, with this information, I want all of you in the chat. So get comfortable with the chat. Go ahead and find your chat box there. I'm going to see if you can tell me what's going to show up on my next slide here. Okay. So I'm going to ask the question. I want to know how to improve and maintain my credit score. Based on what I just told you, can you tell me what the recommendations would be for improving and maintaining a credit score? So go ahead and tell me what's going to show up on this slide here based on what I just shared with the 5 factors in a FICO credit score. Submit it via the questions panel. Yeah, sorry to cause some confusions there. Okay, first one came in, make payments on time. Boom, pay accounts on time. We got that one right. What's next? Second biggest factor in a score, second biggest way to improve and maintain a score. Go ahead, use the, okay, so we had diversify your credit. I'd say that's a good idea, but it's not the second biggest factor I would say that's needed. I'd say for improving a score over time, diversifying may help. We have keep old accounts open, pay at least the minimum payment. All right, we're getting close. So the second biggest factor, or the second biggest thing you'd want to do, would be, there you go, someone put it, an anonymous attendee, and someone else as well. Keep your balances low and pay less than a third of the available credit if you can, and then keep paying down your balances, right? So if you want to, after you pay the account on time, just make sure you're consistently paying those balances down as quickly as you can. And then the third would be open for and apply for accounts only as you need to. Don't go out, and you do want to establish lines of credit, right, to build your credit over time, which we'll talk about establishing credit here in just a minute. You do want to do that, but don't go crazy with it, right? Don't try and apply for 6 things all at the same time. Just do it step by step, right? If you have student loans right now, you already have a credit report, right? So what would the next step be? Well, maybe I'm looking for a car loan. Okay, that would be the next loan I could get to kind of diversify there, or just establish more credit. Or maybe it's the credit card, just to have the tool to use, and manage that appropriately, right? So apply for those things only as you need to. Here's the secret of credit. I'm going to call it the secret, but it's not a secret at all. This is public information that everybody knows and has access to. You do these three things with your credit. Once you've established your credit, you don't have to worry about anything else. There's no secret, there's no nuances, there's no magic potion, right, for improving your credit score. It's whatever's reflecting on your credit report. Are you paying on time? Are you keeping the balances low and minimizing risk by paying down the balances that you have? And are you not going crazy opening up too much, which opens up a door of obligation or risk with particular things. So if you do this well and do it consistently over time, you're pretty much managing and improving your credit as you need to, right? There's no secret there. It's really a question of how do I get to a point of things that are on my credit report? How do I establish it if I don't have it established so that I can do these three particular steps as I move forward? So how do we establish and build credit? Well, first thing I would recommend, let's say you don't have um, any credit at all. Establishing a relationship with the credit union is a great place to start because they can be a resource to give you a line of credit, a credit card, and their understanding of how you manage things that may not report on your credit report helps them feel comfortable on lending to you. So check out the credit union's website under products and services. There is a page with I believe it's called student banking, if I'm not mistaken. There's also a list of other products and services under that products and services tab. Get familiar with what products you can take advantage of to establish that relationship. And maybe it's as simple as starting with the college life account. Just get that account to manage the checking account and have a savings account to build that relationship with them because they're going to want to know, right? Do you manage your checking account well, or are you overdrawing your account, right? So these are things that may not reflect reflect on a credit report. But if they see you've got a checking account, you're managing it well, you've got a little bit of a savings account, okay, we feel comfortable, right? Lending to you because you've done well managing what's already available to you. So that's a good way to start at least that relationship of getting some products or services, establish a relationship, and then establish some lines of credit. So if you have student loans, again, you typically already have that credit report with some history, but establish some other lines. Get a credit card and just use the credit card wisely. We'll talk about that in a second. Or maybe get a loan for something that you need or want and start paying that back. By establishing those lines of credit, you'll establish the length of credit history, start to get a positive payment history if you're paying it on time. It'll help with your ratios as you're keeping your credit card balance low or paying down the loan that you take out. Just getting those lines of credit established will help build the profile. Again, do this in a wise way. Don't establish it just for the sake of establishing it. Establish these things because you're going to be doing it anyways and manage it well, right? You don't need 12 different credit cards. You don't need a bunch of different loans and pay interest unnecessarily. For things that you're already doing, use these tools to help build your profile. And then use these, I've highlighted it, but I'll highlight it again. Use the credit wisely and focus on timely payments. And so I'm going to give you a few recommendations here in just a second on how to do that. So just as you're already doing life, use these tools that will help report these things to your credit report to build that profile. In the Q&A, how important is it to start establishing and building credit versus just having a debit account? A debit account is a good way to do number one, or the bullet one on the screen, which is establishing the relationship with the credit union. A debit account, though, does not, a debit card does not report on your credit report, right? It's just the money that's coming and going from the checking account. The debit card is one of the tools linked to that checking account. So it's not going to create an established credit report. So let's say you had to um, borrow from an entity that's not the credit union, for example. Your debit accounts or your debit card's not going to show up on your credit report. So they don't know how you're managing trade lines, right? Debit or credit, debt or credit accounts that are on the credit report. So establishing the credit makes the understanding of how you're managing those accounts more broad to more than just one party, right? So the national credit bureaus can pick up on a credit card and get that payment history as opposed to a debit card, which is not reported on the credit report. Hopefully that helps. And then a good reminder in the chat here, once a member, always a member, even after you're no longer a student, which is great, right? So that relationship that you start with the credit union continues on, right? Even if you're no longer a student. So that's important. So establishing and building credit, again, you're only, this is, something I'm very passionate about in the sense of don't get credit, don't get loans unnecessarily. Life in a lot of cases will allow you opportunities to get these things. So just use those opportunities as they come up. Don't make it too complicated. Just use what's in front of you well, and you'll do just fine. So if you do get a credit card, for example, let's say you don't have one and you get one, great tip with something like a credit card. A credit card is a tool. Let's use it wisely. So we're not getting a credit card so that we can spend beyond our means, right? It's more for convenience. A great way to establish credit with a credit card, use it for a small purchase each month, and then set up automatic payments to pay the bill on time every month. So maybe you have a subscription service and it's $30 a month. Have it pay for that item, then set up automatic payments. You're now establishing a positive payment history. So whether you're spending $30 a month, whether you're spending $5,000 a month on the credit card, no difference in the sense of on-time payments. If you're paying your payments on time, that's the most important factor in a credit score. So you can build a strong payment history by charging, a subscription service on the card, pay it in full. You're doing just as well as someone who's spending a whole lot more money trying to do the same thing. It makes no difference at all if you're paying those things on time. But again, if you're spending a lot, but then you can't pay it, now you're carrying a balance, now that impacts your debt to credit ratio and other things. You don't want that to happen unnecessarily. So small purchases, pay them on time each month, you're establishing credit. It's very simple. You don't have to go crazy with it. Do know though, there's a temptation with the credit card, right? It gives you available credit that you should be able to pay back if you did charge up to that limit, hopefully, but you don't have to use that available credit. So there is a temptation there of spending more than you probably should. Just be mindful of you. Is that a temptation, having that available credit to you? Just keep that in mind if you're using a credit card. With student loans, understand when repayment begins, right? So whether it's federal loans now and when will you be required to start making payments again, or after graduation, there's sometimes a grace period or repayment may begin right away. When does that repayment period begin? Can I start make sure you're making, on-time payments for that when you need to. Make sure when you're given an option for certain types of repayment plans, so whether it's a standard repayment or extended repayment, a graduated repayment, understand what those are and what's appropriate for you, and make sure that you get the right repayment plan on those particular loans, so you can make sure you're making on-time payments. And automate those payments on the student loans too, right? There are typically options to auto draft the payment, and maybe you sometimes even save a small percentage by doing that, but automate those payments so you don't forget and miss a payment, because even simply missing one payment on student loans or a credit card or a loan can have an impact on the score. So be mindful of that and pay things on time. Some additional tips with establishing and building credit. Automate payments for all debts. So you've heard this for the third time in the last 3 slides. This is the easiest thing to do because it takes you out of the equation. Automate payments for all debts. Keep accounts open, right? So if you're establishing credit, if you have a thin, credit profile, keep accounts open. Even if you're not using them a whole lot, having the length of credit history and the history of that account can be a positive thing. So don't close things unnecessarily if you don't need to. And then third, don't overlook your budget. Your ability and your capacity to pay things on time, to manage those debt and credit accounts appropriately, is all predicated upon your behaviors with your budget. Make sure you have the income coming in so that you can pay these things on time as you go out. So keep that in mind too. What I want to do next, let me jump in here real quick and make sure we'll get through this. I want us to pretend that you're a credit expert answer a few scenarios for me. So through the Q&A, let's see if we can run through these relatively quickly. So pretend you're a credit expert, pretend you're Luke, right, presenting this situation right now, and someone puts in the chat, I don't need to check my credit report because I pay all my bills on time. What would your response be to this individual? Go ahead and put for me an answer in the Q&A. See if you can answer this scenario for me or respond to this scenario for me. Yeah, so first one that came in, still check it because there could be mistakes. Absolutely. You have the access to the information, check it to make sure it's correct, make sure you understand what's there, and also you'll learn as you check your credit report regularly. Scenario two, let's say someone says, I should never close a credit card because it'll damage my credit. And closing a card can impact a score because it affects the debt to credit ratio of your overall profile and the calculation of your score. I'll actually answer this one for you. In general, as we've talked about today, if you're establishing credit, keep your accounts open, even if you're not regularly using them. It's not going to hurt your score if you have a good payment history and a zero balance on a credit card. It's just going to show you've got a lot of available credit. That's fine. So keep it open, but do know in the future, let's say you've got a much stronger profile in the future, you've got an old department store card you don't use, you don't want to really, you know, keep an eye on it anymore. It's okay at times when appropriate. Notice all the disclaimers there. At times when appropriate, you could close a credit card that's not being used, and it's not going to really hurt your situation. But typically it's when you have a strong credit profile. So do know there are some nuances with credit as far as what's the appropriate decision for your particular credit profile that we do need to keep in mind when you make certain credit decisions. But overall, all else being equal, just keep the account open. It's not going to hurt your score. Now, good question in Q&A. What about keeping open credit cards that require fees? That would be up to you. So if you're paying an annual fee on an account, should you keep it open? That's up to you. If you can find an account that doesn't have a fee, I would maybe just switch it out for one that doesn't have a fee so you don't have to pay it. And that gets to another question that came in the Q&A. Does not using a credit card for a month or a few months negatively impact your score? Do we need to maintain or spend a minimum amount each month? So not using a card for a few months doesn't hurt your score, right? It's just going to have a zero balance. It'll show all your available credit, which is a good thing. So that's good for your credit score. But what the creditor is going to want is for you to spend periodically because they don't want to maintain the records on that account, keep updating the credit bureaus if they're not making any money on the account or there's no activity on the account. So I recommend if you have an account to establish your credit, but you don't need to use it, just every couple of months, make a small purchase, pay it in full. Because some creditors, after a period of time where you don't use your card, they will close it if you don't use it. So, but it's typically 6 months or more before that takes effect. So again, don't use the credit card and not pay a balance and pay interest unnecessarily. Use the card for a small purchase, pay it in full. It's just like you're using it like a debit card, but it's reporting on your credit. So that's a good thing. Scenario 3, and we'll wrap this real quick here. Let's take two people, exact same credit scores, exact same credit report, exact same income, exact same behaviors with their money, except for this one account. Maria has a credit card, $1,000 limit, $900 balance. Andrew, $20,000 limit, $10,000 balance. Who has the better credit score? Go ahead and put that in the Q&A. Who has the better credit score? Maria or Andrew, based on what we know today? Yeah, answer is Andrew. Why? He has a lower debt to credit ratio on this credit card, right? Good. Let's change the question though. Who is better off financially? Who is better off financially? Maria or Andrew? Go ahead and put that into the Q&A. Who's better off financially? I'm going to make the case that it's Maria, right? Because overall, again, exact same scenarios for both of them. But Maria, she only owes $900 on her credit card, whereas Andrew owes $10,000, right? Would you rather owe $900 or $10,000, right? So financially, overall, Maria is better, right? So her credit score is telling us one thing, The amount of debt that's owed, though, is a different story, right? It's a lot less for Maria. This, again, goes back to a point we made earlier. A credit score is not a financial health score, right? So let's maximize our credit with what we know, right? Use our credit well, manage our accounts well, pay down our balances. Don't carry over balances if we don't have to. Do all of that well, but also focus on building up your savings, have smart spending habits, those sorts of things, right? So focus on those other things too, overall. And utilize your resources. The credit union's website, there's a learning tab, and then there's a link for financial wellness. Ton of great information there. Keep learning from that. One section in there is what's called Learning Lab Plus, which is which is excuse me, I've got a child saying hello in the doorway. The Learning Lab Plus is online courses to teach you about various financial topics. So check out Learning Lab Plus. It's free. You can register and then take those particular courses. And then with GreenPath, utilize GreenPath for a financial assessment. You can give us a call. We can look at your budget, talk about your goals overall. So feel free to utilize that. Some takeaways for you. Credit's a tool. Let's use it to our advantage, right? So hopefully I've given you enough to know how to use this tool to your advantage for establishing credit and maximizing that. Create a reminder to check your credit reports each year, or again, even more frequently now through annualcreditreport.com. With the pandemic, you can do it more frequently. And then don't overcomplicate credit. Hopefully what I've shared today is pay things on time. Don't take out too much debt. And if you do, start to pay that down, reduce that risk, and only apply for things as you need to. If you keep it simple, it'll stay simple. It doesn't need to be complicated. And then the last question in Q&A that I didn't answer, I'll answer that. And then I'll pull up GreenPath's information and then toss it back over to Sarah. The question is your credit score internationally shared, or does it start again in every country? Every country has its own credit scoring credit bureaus or credit scoring models. So what you get here in the US, it's not going to carry over to another country if you move, for example. So just kind of know how they do credit in each country that you're in. And then, again, use that knowledge to whatever your particular situation is. So feel free to call GreenPath, check out the resources on the credit union's website, and hopefully this has been a informative session for you. Sarah, I'll toss it back to you, and thanks everybody.
Awesome. Thank you so much, Luke. It was great to hear a little bit more about building and managing credit in a responsible way, which I think is the key there, and definitely rightfully pointed out many times.